Hi, thank you for watching Dig Into China. I'm Dong Xiang. If you have not done so already, please subscribe to my channel. Thank you very much. Today, let's delve into three significant developments. Firstly, there is a notable shift in real estate policy, with the central government decentralizing authority to local governments. This implies that different cities may encounter diverse trajectories in their real estate markets. The second development revolves around the substantial surge in China A shares at the close of January. Data indicates that within a week at the end of January, the Communist Party injected $11.9 billion into A shares. This amount ranks second only to the funds used by the Communist Party during the 2015 stock market crash for market stabilization. Notably, PetroChina's stock price has surged by over 20%, underscoring the significant investment by the Communist Party to bolster the stock market. The primary focus is on injecting funds into China's unique valuation system stock to stabilize the broader market. The third development involves the recent announcement by the China Banking and Insurance Regulatory Commission. It permits foreign capital to hold 100% equity in banks and insurance institutions, eliminating all restrictions on foreign involvement in China's financial industry. Effectively, foreign banks now enjoy equal status with domestic counterparts. This substantial policy move aims to retain existing foreign capital and attract more. However, the question remains whether such substantial policy concessions can genuinely attract foreign investment and restore confidence in the Chinese market. This is a development that warrants close observation. Let's break down these developments one by one, starting with the real estate policy. On January 26, the Ministry of Housing and Urban-Rural Development declared a significant shift. Cities are now granted full autonomy in regulating real estate, allowing them to tailor policies according to their specific needs. Similar statements have been made in the past 2 years, but during that period, the central government's actions often contradicted their words. Whenever local governments implemented noteworthy real estate control measures that didn't align with the central government's preferences, intervention promptly followed. Instances include cities like Qingdao and Suzhou, where attempts to remove restrictions on second-hand home purchases were swiftly halted by the central government the next day. Even in more recent cases such as Shenzhen, where the local government experimented with allowing direct relatives to gift properties without a charge, the central government intervened promptly the following day. Historically, despite verbal assurances from the central government, their actions told a different story. Local authorities had to adhere to the central government's guidance on real estate regulation and couldn't act independently. However, in this instance, there is a tangible shift as observed on January 27th when Guangzhou swiftly exercised its regulatory autonomy. The measures implemented were robust, essentially discarding the conventional policy of restricting property purchases. Take the first measure, for instance. It involves removing the purchase restrictions on residential units with a floor area of up to 120 square meters. In practical terms, this means that regardless of the specific district in Guangzhou where you are looking to buy a house, as long as the property is smaller than 120 square meters, there are no constraints on the purchase. This represents a fundamental departure from the previous policy of restricting property purchases. For most citizens, the ability to buy a 120 square meter property in a first-tier city is already a commendable achievement and more than sufficient for their housing needs. Another significant aspect of the new policies in Guangzhou is the second measure, which offers a notable concession. Within the restricted purchase areas, if you own residential property for self-use and have registered it for rental purpose, or if you have directly listed it for sale, these properties are exempt from the purchase restrictions. For instance, if you own a property in downtown Guangzhou that you have rented out to someone, with the rental duly registered, or if you have already listed for sale, as long as these details are verifiable in the database, purchasing another property in Guangzhou would be considered your first property purchase. It's as simple as that. Hence, when I mentioned that Guangzhou has essentially eliminated all constraints on property purchases, it means that these restrictions exist only in name, as they can be easily bypassed. If someone owns a property, they can casually have a friend rent it or simply list it for sale without completing the transaction. It's that straightforward, making it appear as if they are no longer considered property owners. One could argue that the property purchase restrictions are effectively rendered meaningless. This underscores the significant magnitude of the policy changes implemented in Guangzhou. Furthermore, what's paramount is that Guangzhou's new policies were put into effect immediately upon announcement, and the central government did not interfere. Usually, the central government tends to voice opinions and demands prompt reversals if displeased. However, this time, the central government has fully delegated authority, suggesting that the real situation in the real estate sector and China's financial challenges might be even more critical than anticipated. It's significant enough to force the central government to grant autonomy to local authorities. However, once this authority is devolved, there are both positive and negative aspects, particularly within the context of Chinese system. In more democratic nations, local autonomy is generally viewed favorably, but in an authoritarian state, it can be a double-edged sword. Take Guangzhou's proactive approach in this instance. It is evident that their goal is to attract external funds for property purchases in the city, leveraging the inherent allure and a stronger investment value for a first-tier city compared to second- and third-tier cities. This move might trigger a sense of urgency in other cities, prompting them to swiftly adopt similar policies, potentially even surpassing Guangzhou's initiatives. First-tier cities like Shanghai, Beijing, and Shenzhen wouldn't want to lose out on the purchasing power from second- and third-tier cities to Guangzhou. Consequently, they are likely to compete with Guangzhou to attract investments. In order to safeguard their purchasing power, second- and third-tier cities might ramp up the intensity of their policies, potentially leading them to proactively implement various welfare measures. For example, individuals buying homes in these cities might be eligible for subsidies on their children's education, tax incentives, and yearly complimentary health checkups. Facing challenges in competing directly with the first-tier cities in the open market, these second- and third-tier cities are likely to bolster their efforts with appealing welfare policies. Local governments in coastal cities, known for their flexibility and higher levels of credibility compared to inland areas, are expected to adopt a similar approach to vie for market dominance. These positive aspects, as I see them, come with a downside. Specifically, the inland regions are poised to face more challenging conditions. Given the emphasis on the administrative efficiency of local governments in this competition, it's evident that regions with a less developed economy often have less capable governments, making them more prone to swift elimination. Capital from inland areas might flow significantly towards coastal regions as affluent individuals prioritize safeguarding their assets, leading to a further deterioration of the financial situation in inland areas. Consequently, there is a possibility that these regions may resort to more manipulative measures impacting the general population, and this is a matter that requires our vigilance. Moreover, there is another aspect to consider. The centralization of real estate policies is beginning to shift. It's apparent that the central government, under the pressure of economic circumstances, is reluctantly relinquishing control. Given this development, we can confidently speculate that the central government might extend its trend to delegate authority in other economic sectors. With a significant decentralization of power, economically developed regions, particularly in the southeast coastal areas, could potentially attain a level of economic independence. This raises the possibility of the resurgence of regional economic alliances. The central government has long been cautious about decentralizing power, fearing potential long-term consequences, and it seems they are now taking a calculated risk. After covering the real estate topic, let's now shift our focus on the A-share market. According to an analysis report from Bank of America, the Communist Party injected a total of $11.9 billion into the A-share market in the past week. This level of intervention is second only to the market rescue during the 2015 stock market crash. Consequently, foreign media suggest that A-shares might see continued short-term growth. A-shares could experience further short-term increases. The reported $11.9 billion intervention is only a fraction of the rumored $2 trillion offshore yuan, suggesting there might be more resources available. I want to reiterate that this market intervention primarily revolves around the unique Chinese valuation system stock. If you currently hold these stocks, consider exiting at an opportune moment. If you are considering entering the A-share market now, your options might be limited to these stocks. However, it's crucial to acknowledge the substantial risks involved, so exercising caution before entering the market is advisable. Moving on, let's delve into the financial sector. The Communist Party has taken unprecedented measures by fully removing restrictions on foreign investment. It's important to note that in China, many foreign banks face limitations on their operations, with restricted business opportunities and a narrow operational scope. As a result, the competitiveness of foreign banks in the Chinese market has not been on par with that of Chinese banks. If the restrictions on foreign bank operations are indeed lifted, it has the potential to significantly boost their competitiveness in the Chinese market. Over the past 5 years, we've observed many Chinese branches of foreign banks downsizing, with Citigroup even closing its retail banking operations. Their decision was driven by their belief that the Chinese economy was in decline, coupled with the restrictions on their business scope, leading to a pessimistic view of the Chinese market. However, the Communist Party has now extended a sincere olive branch, allowing full ownership and eliminating business restrictions. This appears to be a highly positive development. Yet, let's consider a different perspective. In the context of foreign financial institutions such as Citigroup and the Bank of America, how crucial are they to the Communist Party compared to a technology-focused company like Tesla? In the event of a sudden rift between the Communist Party and the United States, would the party prioritize expelling Tesla from China or expelling financial institutions? The answer is likely the latter, as these financial institutions don't provide cutting-edge technologies comparable to Tesla's. Cutting-edge technologies are the real key factors that could pose a genuine threat to the United States. Financial institutions, on the other hand, are more associated with profit-making strategies. Therefore, I believe foreign financial institutions will carefully weigh the policy risks. What I can consider, they can consider as well. Unless the Communist Party has secretly negotiated some form of agreement with Wall Street involving certain non-negotiable terms, Wall Street is likely to remain cautious about making significant investments in the Chinese market. As for the future developments of this matter, we can observe the effects of the policy over some time, and answers will emerge accordingly. In summary, the significance of the three major developments discussed today lies in their indication of the response to China's economic decline. Faced with the current crisis, the Communist Party's central government is compelled to decentralize power to local authorities. This signals Xi Jinping's focus on prioritizing economically developed regions, relying on them for economic vitality while potentially overlooking less developed areas. Consequently, it is highly probable that under the influence of self-regulating policies in the real estate sector, coastal regions might draw capital away from other regions, further solidifying their economic dominance. Furthermore, I predict that the second and third-tier cities in the southeast coastal areas will proactively introduce policies to enhance welfare. This is a positive anticipation as they strive to compete with first-tier cities in the market. Competition is expected to drive reforms, and the local governments in coastal cities having a certain degree of governance flexibility are likely to spearhead these transformative initiatives. Apart from the real estate market, the stock market has now officially entered a significant market rescue operation similar to the one seen during the 2015 stock market crash. The Communist Party's clear intention is to infuse funds to enhance the valuation of companies with a distinctively Chinese character. As a result, stocks falling under this unique Chinese valuation seem to be the only segment in the Asia market currently viewed optimistically. It's recommended for everyone to closely monitor this situation. Lastly, the restrictions on foreign investment in the financial industry have been significantly eased. However, unlike manufacturing industries and the factories that can directly contribute to the Communist Party's core technology and national power, the financial sector may not offer the same benefit. In the event of a fallout with the Communist Party, the foreign financial industry could be the first to face consequences. Therefore, the opening up of the financial sector may not automatically result in renewed favor from Wall Street. Given the party's history of policy reversals and the resulting low credibility, continued observation is necessary to assess Wall Street's response. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.